There we go. Okay, I think that'll show a little better than just showing the whole monitor.
Okay, perfect. You have the floor.
All right, thank you. Well, wonderful. Wow, we got a good group here. Thank you, everybody, for being here. This is an exciting event, and I'm very, very honored to be part of it. So, let's jump right into it. We got 45 minutes, so not a lot of time, but definitely enough time to give you a taste of how to trade pure price action. So let's jump right into it. Oops, I got to activate my slide. There we go. So I am Barry Burns, owner and founder of TopDogTrading.com. I'm also the author of Trend Trading for Dummies. I've received numerous Reader's Choice Awards from Stocks and Commodities magazine year after year. Very happy with that. That one actually means a lot to me because it's voted on by, well, real traders, just, people like you, the real people out there making it happen. I'm also contributed to other authors' books, work with a lot of major companies, done presentations for exchanges. Wow, our scaling got really messed up here. Anyway, I'll just, if you want to, that's just a little graphical overview there, obviously. If you want to see a full list of all of my cred, my full bio, feel free to go to topdogtrading.com, click on the About Me tab, and you can see the entire list there. Also, another freebie that I offer is the Top Dog Trading Podcast. So if you like podcasts, whether it's iTunes, Google Podcasts, Stitcher, Spotify, pretty much anywhere that podcasts are available, we are there. And obviously, podcasts are free services, and I post a lot of good free stuff there for the general trading community. Check it out. And while you're driving, working out, or whatever, we can learn about some trading at the same time. We've done pretty good, thanks to all y'all. That's a deep South term, all y'all. You guys with your ratings, reviews, all that kind of stuff, stars, have on iTunes pushed us up to number 10. That's the last time I looked. In fact, kind of amazing, ahead of Mad Money with Jim Cramer. Who is that guy? Never heard of him. Anyway, we have done pretty well with that. I don't monetize the podcast, by the way. I don't do any advertising on it. Got nothing against those who do, but no, it's just a totally free service for the community. I'm sure that you guys see these disclaimers all the time, but it's very important, and I just want to put a little different angle on it, maybe that don't think of this as just legalese, because it really is where your education begins and continues. In fact, not bad even as traders who have been around for a while for us to reference this periodically, because it's really the regulators doing us a great service, an educational service. As I'm sure you know, most people do lose money trading. And what they have done is they've gone out and they have found out why. And then they put it in these legal disclaimers. So, pretty good information to know. Since roughly 80% of the people lose money, well, this is at least a first step on the road of how to step out of the 80% into the 20% and avoid the most common ways that people lose money. All right, now, having said all of that, let's get into the meat and potatoes today. Oh, sorry, for those of you who are vegetarians, we'll get into the kale and the broccoli. And the kale and the broccoli, both of my daughters are vegetarians, so I can tend to be very conscious about that. I always forget, and they razz me. So we're going to start out with some really, 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 really basic stuff here today, and then we'll get into some deeper stuff, so kind of meet everybody's needs. So for you who have been trading for a while, just be a little patient here as we cover some real basics. We're not going to spend much time on the real basics, and then we're going to get to some really cool stuff that you may not have seen before. So, all right. For those of us who are traders, we're going to look at some just basic candlestick stuff. I'm not going to go into, the Japanese names and all the details. I just want to give you basically the psychology behind what's going on in a candlestick bar, how to kind of read what it means, the underlying part of it. So, first of all, so here's a single bar candlestick, and what's important here is the range of the bar from the low to the high. That's the first thing. And so a meaningful candlestick bar will be a wide range bar from the low to the high. Anything, to me, in my opinion, anything that's a narrow range bar is pretty neutral. Pretty neutral. And then the other thing that's important is the range of the real body. And the real body is the open to the close. And so if it's green, it opens at the bottom and closes at the top of that real body. And what is the range of that? That's the second aspect. So again, if we've got an open near the low and a close near the high, that is a very, very bullish candlestick. Okay, so kind of keep those two concepts in mind, and because that's going to be the foundation, the building block of everything else we talked about. And just the opposite for a bearish bar, wide range, opens near the high, closes near the low. That would be a very bearish one bar pattern. Now, having said that, going to one more step in the logic of this. So here we have a wide range bar from the low to the high. But now if you look at the real body, the open to the close is a narrow range. And so this I consider to be a bearish bar. Now I'm not concerned about whether it's a green or a red real body here. So whether it closes above the open or opens above the close, I don't really care when the bar or when the real body is that narrow, because markets are kind of noisy, right? There's an element of noise to them. And so you can't get persnickety about every penny, pip, tick, or pixel on your monitor, if you will. And, as long as it's narrow range, that means that really the open and the close are close enough to being the same that, well, in fact, let me bring up my little drawing tool here. We got some cool drawing tools here on GoToWebinar, so let's take advantage of it. So what this means here in market auction theory, and specifically as delineated by market profile, which we're not really getting into market profile, but the concept behind it is really good and does apply here, is that all of this price action here, all this price zone was rejected by the market. So we call this a rejection of value. All right, so we opened down here, we closed here, pretty much in the same proximity. So after all was said and done on this bar, whatever it is, it's a minute bar, 5-minute bar, 60-minute bar, daily bar, monthly bar, whatever, quarterly bar. Did you know that WD Gann actually used to trade quarterly bars, meaning each bar represented 3 months of price activity? You don't see too many people doing that anymore. But it's all relative to the time interval. So the fact that the market rejected these prices, in other words, the auction place tested these higher prices, could not get enough traction, okay, and then came all the way back down by the time this bar closed, means that the market did not agree among all the participants that, yeah, it's worth that much. It's worth that much. They said, no, after all was said and done during this time period, they said, we're valuing the market down here. That's what it is. Okay, that's what we're going to be willing to buy. We're going to be willing to pay for it. So that's why that's a bearish bar, because it rejected all those values above the real body. All right, so just setting you up with a little, again, talk about, learning how to fish instead of just giving you fish, as our previous speaker talked about. Trying to build a foundation so you can learn how to fish on your own. All right, so opposite here, not going to spend too much time because it's just the opposite, open and closed up here. And therefore, this whole level is rejection of value, these price levels, and therefore that is a bullish bar. Don't care that this part is red, personally. Again, not significant enough when you get a narrow real body. All right, so building on that foundation now. Now, those are just one bar patterns. So let's go to 2-bar patterns. So now based on 2 bars, we have a bearish bar here, and we get a bullish bar there. Therefore, within the 2 bars, that is a reversal pattern, and therefore the end result is that it is a bullish pattern. The market turned around, and what it did was just the first bar is negated by the second bar. All right, and reverse here, same thing, except now we got a bearish 2-bar pattern. And the second bar it makes the first bar insignificant in the sense that market sentiment has changed, and therefore we often will see this at swing highs. All right, now what about this one? So now, again, we're combining kind of the single bars that we put together into two bar patterns. So a little bit of a bullish bar here, but now look, that long wick or that long shadow, whatever your preference is for terminology, rejected all these prices up there, and some traders trying to buy up there, some traders trying to sell up there. But after all was said and done, the majority said, nope, not willing to pay those high prices. And so therefore, this is a two-bar bearish pattern. All right, and again, whoops, gotta turn that off. Good to whoever, I won't let me change slides anymore with drawing tool activated. It's a little annoying. Gotta keep going back and forth and deleting that thing. Okay, but anyway, and so this is a two-bar bullish pattern because again, rejection of these lower prices indicate that nope, now people are not willing to sell down there, and they want more. Whoever is owning the stock, the forex, whatever it is, they're saying, we're not going to take lower prices anymore. We want higher prices. We're not going to sell unless you pay us more. And that's the basis of market action is supply demand. Where are people willing to buy? Where are people willing to sell? Okay, and then finally, the last two-bar logic pattern that I'll show you is this one. You get a nice bullish bar followed by a neutral bar. Now, again, any kind of narrow range bar from high to low, I just consider a neutral bar. Don't care if the real body is green. Don't care if it's red. It's not significant enough to matter. Markets are not that precise or accurate. You got to figure you got people all over the world trading. This is the S&P 500 especially. So all different countries trading all different technical analysis techniques, all different time frames, all different methodologies, and therefore, a few pennies here, a few pennies there really doesn't mean a whole heck of a lot. So this is a two-bar bullish pattern because the second bar just is neutral. And so therefore the first bar, which is bullish, that remains in play. That is still where the sentiment of the market is, has not changed, just paused for a little bit. Okay, so now that we have done that, let's do some quizzes. Oh my gosh, are you really going to test me in the morning? Tired. Okay, well, market doesn't care if we're tired. So let's do a couple of quizzes here and see if we can put all this together. All right, so now, I cannot see the question box, so if you're making comments or whatever, I can't see them. If you type into the chat box, I believe I can see that. So nope, actually I don't think that I can see there either. Okay, so we'll just have to kind of walk through this. Oh, wait a minute, question just came up. Oh, thanks guys, awesome. Dudes, now we got it. Okay, appreciate that. So now we actually can do we can have some interaction here. Cool. All right, so now let's do some quizzes because the market will quiz you and the market will quiz you and your grade will be not a letter grade, but it'll be a numerical grade called money, honey. So this bar, this green bar, should actually circle the bar, I guess. This green bar, go ahead and type in. Did the market validate or invalidate the price action of the bar that precedes it? Okay, we get red coming down. And then so right now, we're in a little bit of a bearish mode. This bar here, just this one bar, we're just talking about a one bar pattern now. Does this validate the move down or does it invalidate the move down? Type in your answer, or does it do neither? So I guess there's three answers really. Validate, invalidate, or just really has no significance whatsoever. Okay, so let's see what we got here. And I'm not going to call out names because I don't want to embarrass anybody. So good, thank you, Coleman. I'm just going to acknowledge people who are participating because we love to acknowledge participation. Coleman, Paul, Eric, Ian, Fred, Kurt, San, Ian, Paul, Charles, Marvino, Trudy, Brad, Ian, Aruna, Paul. Very good. All right, everybody. Thank you very much for participating. Sanford, John, a few others. Still, people are still typing in. Okay, so the correct answer, at least according to myself, is drumroll, please. It does neither. It does neither. Now, this is I actually started it out with kind of a trick question because, and I'm sorry about that, but the market's going to try to trick us all the time. And by the way, it really does because everyone's trying to get the money into their account. Where's that going to come from? It's not going to come from some neutral money pool. It's going to come from someone else's account, yours. And so the market is never trying to make things easy or obvious for you. It's actually always trying to do the opposite because everyone's trying to take our money. So, but it was a little bit of a trick question, and I kind of set you up for this on purpose, but I did it to help you, not to fool you. So this is called forward-looking bias, where I showed you the rest of the chart over here. And this is where you can get into some trouble as you're looking at historical charts to develop a trading methodology, is that we see what happened in the future. And that gives us a bias then as to the fact that we think we should be able to know that there was a cycle low there or a swing low. And then we reverse engineer that in our minds to say, well, how could I have known that? Sometimes the answer, my friends, is that you could not have. Not every swing high, not every swing low has a nice, beautiful reversal pattern. In fact, most of them do not. And this is a very important lesson to learn because, again, people often try to say, gosh, it went up. How could I have known that it would have gone up? And they'll do all this kind of research and study and waste their time because a lot of times there's no way you could have known. The market didn't tip its hand that time. And so what we do as traders is we wait for those times when we do have a probability scenario where there is some sort of good, solid indication. Doesn't necessarily mean an indicator, right? Today we're talking about price action, not indicators. But we've got to understand that, hey, sometimes there was just no way to know. Sometimes there was no high probability trade there. And so it put in a cycle low. So what? Doesn't mean you should have traded it. There's no way we're going to know every single one. So the reason it does not validate or invalidate is because two things. Number one, just as we talked about, it's not a wide range bar from high to low. And number two, it's not a wide range bar within the real body, the green part. It's a narrow range bar with a narrow range real body, and therefore it's a neutral bar. And so it didn't do anything just because the market went up. So what? Okay, that, by the way, my friends, is a very important lesson to learn. Very important lesson to learn. Okay, now, having said that, let's go to the next one here real quick. So what about this bar? Does this red bar validate or invalidate the bar before it? Go ahead and type in your answers. And one question came in, price closed higher than the previous candle, so it has a buy signal, right? Actually, let's see, price closed higher than the previous candle. Price did not close higher than the previous candle, actually. It closed, oh, you mean higher than the previous candle's close, probably. No, that's insignificant noise. No, too narrow range for it to have any meaning. Again, this is where you have to be real careful. Those little types of movements there are not significant enough to really have any significant meaning. Okay, so answers have come in, and let's see. Very good, very, very good. Okay, thank you, everybody. So this bar does invalidate the bar before it. Again, wide range bar, remember, are two rules. There's really just two rules that we're working with here. And that is, for the one bar, that is at least, wide range bar. Yep. And how do we define a wide range bar, by the way? That's a good question. So wide range bar is relative to the recent bars. We want it, again, it's all relative in the market. And you can use a number like 20, or some people use 40 bars, and say, okay, relative to the last 20 or 40 bars, is it wider range than the average bar? And now, again, if they're all really narrow range bars, then I wouldn't use that rule. But if that bar on its own is wide range and wider range than most of the previous bars, then I'd say, okay, it's considered a wide range bar. Um, in this case, it does close below the low of the previous bar, and it's wide range. So therefore, I would say, yeah, that invalidates the bar before it. All right, what about this? This is a one here. All right, looking at some other stuff here. So that bar there, does that validate or invalidate the bar right before it? Type in your answers now or forever hold your peace. By the way, I'll just acknowledge more people answering. Fred and Mark and Kurt and Marvino and Marvin and Coolman and John and Trudy and Piotr, Sagoon, Francisco, Kiss, Nima, Mark, Brad, Sanford, Deborah. Awesome. Appreciate it, guys. So the answer is actually neither. That's correct. It's a neutral bar because it's not real wide range compared to all these other bars here. You cannot say that that bar is more wide range than, all these bars here. Also opens and closes at the exact same price. Closes a little bit below the mid-range of the bar. Again, if that was a wider range bar, I would give that significance, but because it's a narrow range bar, I don't. And so therefore, we remain bearish. This is just, market has its little ebbs and flows, little bit of retrace there, real tiny. So what? Our bearish sentiment continues. Okay, you guys are doing pretty good. Starting to catch on to this. Very good. I'm impressed. You guys are smart. And then the last one here we'll look at is this one right here. And this green bar, does that invalidate the bar before it? Go ahead and type that in. Oh, good, 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 good. Awesome. Good answers. Thank you, Fred, Coleman, Francisco, Trudy, Ian, Keith, Marvin, Brad. Yes, invalidates. Invalidates. Correct. All right. Wide range bar, wide range real body. And you guys are getting it, I think, and some of you already had it. So awesome. Okay, so those are just the real basic stuff. Now, Barry's going to make it harder for you now. So that was given the benefit of forward-looking information because you have to see the heart or the right side of the screen after the bar. We're not going to do that anymore for you because the market's not so kind that it does that. And I don't know about your broker. My broker won't let me trade historical charts. My broker says, no, sorry, Barry, you got to trade the hard red edge of the screen into the unknown future. My broker's very rude about that. I just can't understand why she insists on that. But anyway, she does, and I guess it actually makes sense. So here's the question now. Now, we're not going to show you the bars that follow. So this bar right here, actually, we're just going to talk about this whole price formation. Now we're going to extend it beyond just 1 and 2 bars. So now we're going to look at multi-bar formations and where we are right here on the hard red edge of the screen. If you were trading, and that's the hard red edge of the screen, what is this 5-minute bar, 5-minute charts. What do you think, what would you expect to happen next? So your answers could be bullish, bearish, go sideways, or there's, again, just there's no probability scenario here. So really 4 answers: up, down, continue sideways, or there's just no high probability situation. You guys are really participating, man. I gotta tell you, I really respect that. Good job. Let's see here. Chris. Donna, Brad, San, Mark, Trudy, Julio, Francisco, Kurt, Bruno, Marvin, Sanford, Marvino, Mode, Nima, Brett, Sagoon, Ian, Eric, John, Paul. Awesome. Okay, so here's how I look at it. And let me take off the notation here to make this a little more clear for you, hopefully. So the way I look at it is, all right, we have a gap. Do all gaps close? No, there's kind of conventional wisdom that says gaps close, or since we're talking about Japanese candlesticks, the window closes. That's how they refer to it. Well, sometimes they do, sometimes they don't. Sometimes you get a gap and go where it doesn't close right away. Maybe it will later in history, but not right away. But here's how I see it. So we've gapped down. Okay, so we are looking at that space. That's on our radar. We're looking at that. Market actually continues to come down a little bit, comes back up, comes back down. Now, when it comes back down, what kind of candlestick bar do we have? We've got a wide range bar, got narrow range real body, opens and closes near the high of the bar. Okay, in the top third, I kind of use thirds when I look at this kind of stuff. So what we did here, so this is definitely a one bar bullish bar. Okay, but that and a $20 bill will get me, have a cup of coffee at Starbucks with a homeopathic amount of caffeine in it. So, but it's one piece of evidence, right? Enough to trade on? Not necessarily, but it is one piece of evidence. Another piece of evidence is that we came back down and we retested this low, or we tested this low. So that, when you put those two things together, that actually does carry a little more significance. So actually, we're putting three things together. We're putting together, we've got a gap, and so we're asking, is that gap going to fill, or are we going to get a gap and go down? Market does go down a little bit, but then when it retests this low, it rejects those lower prices down there with that long wick, rejects them. And therefore, for that reason, I would expect it to go up and to be a gap close this time. All righty. So that's the logic behind that. And we put that all together, three things: gap, retest of the low with rejection of value, and we expect a gap close. All right, what about this one? What do you expect the market to do? Go up, go down, go sideways, or just no probability of knowing? Go ahead and type that in. Alrighty. Very good, very good, very good. Okay. So yeah, that is again, see what we've done now here in these examples is we've added some other elements. So price action and support resistance go together. And it's kind of like, what's that old song, Love and Marriage Go Together Like a Horse and Carriage? What was that from? Oklahoma, I think, the musical. I think it was that one. But anyway, so we look, price action is something that's very significant to look at support resistance levels. Now, I draw support resistance off of the real bodies, not off of the high, because again, you know, all this stuff here, every penny paper ticks, not so meaningful. The real value is established at the real bodies. Now, you notice though that at this high, it didn't quite come up and touch the line that I drew. Again, that is making, uh, what's the term I'm looking for here? Just allowing the market, it's a little bit of a noise where sometimes it might go a little bit above the line, a little bit below the line. Rarely actually does it hit the line to the penny pipper tick. So you can't get that nuanced with the market. Got to give it that little bit of noise. So we got a little double top here, and then yeah, we got a major wide range red bar, opens at the high, closes near the low. So that is a very good combo signal for indeed a move down. So for those who answered that, good, good. Wish I could give you some money, but you'll get your money when you go trading this. Now, this one's a little more nuanced. This one's a little more advanced. That last one was kind of easy, I think. So what do you think is going to happen here and why? In fact, now we're going to ask you to answer why. Because when you trade, you need to always have or a reason why you're taking the trade. And you should document that in your trading logs so that when you go back and look at them later, you can see which things are working for you consistently, which are not, the logic or the intelligence behind them, so that you can create a methodology based on logic. Okay, so let's see. Very good, Francisco. That's a good answer, Trudy. All right, awesome. Well, we're getting all kinds of different answers here, but we got some good ones. All right, awesome. Actually, some really good ones. So here's how I look at this. Well, here's what the market did, and here's the logic behind it. So we've got a resistance here. And remember how we just talked about support resistance being very, very, very important when it comes to price action. We got clearly a wide range bar and a wide range real body. But here's the key. It closed above the resistance. In other words, it just sliced right through. So now again, adding the price bar and resistance, combining those two, then it's more likely to continue to go through. Look probably here, and just happen to be a perfect example both on the same chart. We've got another wide range wide range body from high to low and wide range real body bearish. So that is a one bar bearish candlestick pattern, but it closed right at the low, at the previous low. So it came down. Did not slice through it, didn't close down here, closed right at it. So sure, one bar really bearish, but that again alone doesn't mean too much. It's one piece of evidence. We're not going to convict somebody on one piece of evidence. And so we got to put together a preponderance of the evidence to use legal terms. And so I really like this example because it shows, and I really want to take the illusion away that when you're reading price action, any one bar means much, because it does not. Now let's add volume to it, because in addition to price action with support resistance, we also need to look at volume. Volume and price also go together like horse and carriage. And so we're going to look at a couple things: large volume versus small volume. We want enough volume, but not too much volume. And we don't want just large volume. What we really want is smart volume. So these are the four distinctions when it comes to reading volume. Again, not all volume is created equal. So let's just take, I'll go through them real quick. Large volume versus small volume. Okay, so that gives strength to that market move. Markets can move on weakness or on strength. When I say enough volume but not too much volume, that's because we don't want exhaustion patterns. Exhaustion patterns are often marked by large volume, but during a price pattern that is an extended trend. But not just large volume. There are two types of large volume. It could be amateur volume, but there's a lot of amateurs coming in. That alone does not mean much. In fact, it would almost be a counter indication, because retail or amateur volume, they're the people who are losing money. So if they're doing it, it's probably not going to work out. So just large volume enough is not a valuable way to trade. What we want to see is if it's professional volume or amateur volume. That's the distinction. Okay, so very important. Now, how do we find this? So how we find it is we use a time and sales window. So here's one on TradeStation. What I like to do is, you can adjust these columns here, by the way. And so type, I make trade. You can have bids and asks show here. I take them off personally. I don't look at those. You can. A lot of professional tape readers will look at bids and asks, and they can do very well with that. For me, and for our purposes today, I'm looking for actual trades that are executed. These are the ones that'll create the volume histogram at the bottom of every chart. Bids and asks don't, unless you got an indicator for that. For my purposes, I like to look at what committed positions are placed, where they've actually sent their money into the wild marketplace. Okay, so that's the first thing. Second thing is there's an indicator, may or may not have it on your charting platform, depending on what you have. This is NinjaTrader on the left. And there's an indicator, and if, by the way, your charting platform doesn't have it, then you can look into the forums or discussion boards of your charting platform, and somebody might have posted this indicator there for free. So check that out. That's another place to get it if it's not native to your charting platform. So here, what it does is it's plotting block trades. So notice that we don't have a volume bar under every price bar. And that's because what it's doing is, in this case, I have it set to only showing me trades here. So what I've done here is I've customized the size column. All right, we got the NQ here. So I customized it to not only show just trades, but now I've customized it to only show trades that have 20 contracts or more in one single executed trade. And I do that because most retailers are not trading 20 contracts, with each trade that they place. They're trading one, two, three, or four contracts, but not 20 because they don't have a big enough trading account to do that. So this is one way to kind of have the market tip its hand and see, okay, where are the professionals coming in? So, and then the indicator can plot this. Okay, and therefore you can see all of this. No, not the pros trading, and then they come in here. So it's just kind of nice. Is it necessary? No, but it's kind of nice to see where it is on your chart as well. All right, now here's one I haven't seen people teach before, so it's kind of my own invention, although every time I say something's my own invention, then someone tells me, oh no, this other guy does it too. So nothing new under the sun, I guess. But anyway, um, I, I'll bring up two time and sales windows. One, I customize the size to be a maximum of 2 contracts. And the other one, I customize to a size. In this case, we've got it a minimum of 10. Minimum of 10. And you can, it's discretionary what you want to do there. If you want to do 10, 20, whatever. So what's happening here? So what's happening is one time and sales window is showing me more amateur volume, and the other one showing me the professional volume, and I can look at them side by side. Notice prices are the same, 1205.75. Okay, so, well, let me just ask you this question. Let's do a little self-discovery here, a little Socratic method. So based on what you're seeing here, I mean, you got one time and sales window at the exact same time, red, and the other one, you got green. So some are shorting, some are going long. Just based on this information, this piece of evidence, what do you think would be better, to buy or to sell? Go ahead and type that in. And because I think it's fairly counterintuitive, or I think it's actually fairly intuitive, but I think it gets it ingrained in your brain cells more if you actually type it in. And yeah, everybody's getting it right. So that's right, buy. So when you see the two together, you're seeing what the retailers are doing, you see what the amateurs are doing, you can see they're doing the opposite, right? Now, is it always this clear? No, it's not always this clear. But again, as traders, we wait until it is. And that's when we trade. When it's not clear, when it's not, or when it's ambiguous, well, we just don't trade during that time. We wait for those opportunities. We wait for the market to come to us. All right, now there's another thing you can do too if you want to get real fancy schmancy with this, which I like to do this, up to you how complicated you want to make it. So this is the time and sales window in NinjaTrader, and you could do a couple of other things here. And so I've got mine colored lime green when not only are they buying, but the order has gotten some slippage. In other words, they're buying above the ask. Okay, and magenta if they're selling below the bid. In other words, that's a more aggressive order. It's a more aggressive order, buying or selling. And then so here are the contracts being traded. And then I added another column here that is block trades. So I said, okay, on this one at 20 is the minimum that'll show up. So it won't even plot on my time and sales window unless someone places a trade for 20 contracts or more. But then I said, you know what? I also want a little more indication here. And so anything that has 50 or more contracts, I just have it plot in a separate column calling them block trades. So here we've got red and we've got green. Okay, maybe a little more red than green. But then I can look over here and I can say, all right, so yeah, we got some people trading contracts, 20, 30 that are green. But what are the really big boys doing? Okay, block trades, 50, 50, 50, 50, 100. Those are all red. So gives you a little extra information as to the not only what the big guys are doing, but what the whales are doing, what the whales are doing. And then here's an example I wanted to show you that. So I've got my block trade indicator on here. And you know, the bane of breakout traders is false breakouts, right? We all know that. So here's a way I'm giving you to help to avoid those false breakouts. So we've talked about support resistance. We've talked about candlestick bars, 1 and 2 bar candlestick patterns. And now we're adding volume because we need more pieces of evidence, the better. So when we get the breakout, which occurs right about there, so now we're getting a wide range green bar. Whoops, where'd my little thing go here? Actually, probably, let me do it this way. So we got a wide range green bar, wide range from open to close. Close is near the high, actually closes right at the high. And now, and it broke above resistance. We've been in a channel, just stuck there for a while. We finally break out. Now, false breakout or real breakout? Will the breakout have follow through? Boom, professional volume has come in. Remember, this is only plotting professional volume, the big trades. Someone's got to have a big trading account to do this. And it, might be more than just one person is trading, obviously. This is going to do the accumulation of all the block trades. And so, yeah, the pros are buying the breakout, and therefore it's more likely to continue. Exactly. Very good. All right. Well, that's it for me. So what I have for you today is don't actually have anything to sell, kind of dropped the ball on that, but I do have something to just give you for free. So if you like free stuff, I got some free stuff for you. So what I'm going to do is give you one of my little mini courses. And in this mini course, though, I give you something of great value, and that's an actual trade strategy. So the mini course is not just theory or concepts or ideas. In this, I'm going to actually give you my rubber band trade strategy. This is a trade strategy that I use pretty much every day. Every time it sets up, I definitely take this trade. It's that good. It has a very high win-loss ratio. It is kind of a scalping trade. It's a mathematical model of the reversion to the mean, but it works just so well. And that's why I'm giving it to you because, frankly, rather than just talk, I want to demonstrate and I want to make you some money. And I figure, hey, just to be totally transparent, if I start making you some money, well, you might want to get some more stuff from me. But, talk is cheap and actions speak louder than words and money speaks louder than actions. So let's get you making some money for free and then we can decide if we want to work together. So again, it contains all the rules and the filters. You're going to get 5 videos here today, actually. And you've seen my little theme here. What I've talked about today is professional versus amateur traders. And that's really what this little series of videos is about. So while you get the rubber band trade strategy, you also get some other supporting videos around that help you to distinguish how professionals trade different than amateurs. Just like we did today, there's some quizzes in there because that really hones in your skill and your knowledge. So you make sure you understand what's being taught. You get a little feedback there. Oh, also, I'll be doing a follow-up webinar next week. So if you're interested, I'll give you my cycle indicator. And this is an indicator that I use on every single trade I take. Every single trade, no matter what the pattern is, head and shoulders, double tops, wedges, triangles. This is what triggers me into the trade. And I do sell that, by the way, but I'll give that to you for free. So you can get it all at just one site. Just go over to topdogtrading.com/free, register there, and we send you everything. So that is it for myself. I want to thank everybody for being here. And thanks guys for inviting me. Been a pleasure. Really enjoyed it, and I hope you got some good value out of it.